Good day everyone. So our group will tackle about basic accounting. So first, let us define accounting. According to American Institute of Certified Public Accountants or AICPA, accounting is an art of recording, classifying, summarizing in a significant manner and in terms of money, transactions and events which are in part at least of a financial character and interpreting the results thereof. So the branches of accounting, we have financial accounting, management accounting, government accounting, auditing, tax accounting, cost accounting, accounting education, and accounting research. In this video, we will focus on financial accounting, which deals primarily with the traditional recording of financial transactions, which would eventually result to the preparation of financial statements that will serve the information needs of various users. Next, we have forms of business organizations. We have single or sole proprietorship, partnership, corporation, and cooperatives. In this session, we will tackle single or sole proprietorship, in which the capital is owned and provided by one person called proprietor. Now, let's move to accounting concepts and principles. In understanding the fundamentals of accounting, we should know that the preparation of financial statements is guided by concepts or assumptions, which are the very foundations of GAAP. GAAP are a uniform set of accounting rules, procedures, practices, and standards that are followed in preparing the financial statements. So they are as follows. First is accounting entity concept or separate assumption. Then we also have going concern, time period concept, unit of measure concept, accrual, and basis concept. Now let's move to the elements of financial position. We have assets, liabilities, and equity. While for financial performance, we have income and expenses. Income equals revenues and gains, while expenses equals expenses and losses. So the account. The account is the basic summary device of accounting. Separate account is maintained for each element that appears in the balance sheet. We have asset, liabilities, and equity, and in income statement, we have income and expenses. The account is the simplest form of account. So we have also here the accounting equation. Accounting equation is a basic tool of accounting. The accounting equation is asset equals liabilities plus owner's equity. Example, assuming the asset is 200,000, liabilities is 80,000, and owner's equity is 120,000. Substituting the equation with the given data, we have asset equals liabilities plus owner's equity. Then we have 200,000 assets equals 80,000 plus 120,000 owner's equity. If the owner wants to determine how much is his claim over the asset, use this formula, owner's equity equals assets minus liabilities. If the creditor wants to know how much are their claims over the asset, you can also use this formula, liabilities equals asset minus owner's equity. If we put accounting equation in a vertical position instead of horizontal position, it will appear like this. As you can see here, the left side is the debit side equals the right side, which is the credit side. We have here the total asset of 200,000, total liabilities, and total owner's equity. Then total asset is 200,000 equals total liability and owner's equity 200,000. If assets are 100,000 and the owner's equity is 40,000, how much the claim of the outside creditors? So the answer will be 60,000. Rules of debit and credit. The equation of asset equals liability plus owner's equity stands for the normal balances or increased sides in each of the accounting elements. Hence, the increased side of asset is the debit side, while liabilities and owner's equity have credit as increased side. Conversely, the decreased side of asset is credit, and the decreased side for both liabilities and owner's equity is debit. as you can see in this illustration. Factors that will cause owner's equity to increase are investment by owner and revenues. Factors that will cause owner's equity to decrease are withdrawal by owner or by expenses. Drawing or personal. It is the reduction of an owner's equity account arising from cash or property withdrawal is not debited to the owner's equity account to effect the decrease but instead debited to drawing account. The debit to drawing account increases the said account with corresponding decrease in the owner's equity. So we have here. Then we also have temporary accounts, which are income or revenue and expenses. As you can see there, decrease side and the normal balance or the increase side. Now let's go to summarization of rules of debit and credit. We debit to increase cash, to decrease in liability, to decrease in owner's equity, and to increase in drawing. We credit to decrease in asset, increase in liability, increase in owner's equity, and decrease in drawing. For temporary accounts, we debit to decrease in income, increase in expenses. We credit to increase in income and decrease in expenses. Now let's go to accounting events and transactions. Types and effects of transactions. Although business entities engage in numerous accounts, all transactions can be classified into 1 to 4 types, namely, source of assets. Examples are purchase of supplies on account and sold goods on cash on delivery basis. We also have exchange of assets. Example, acquired equipment for cash. Or the use of assets. Example, we have settled accounts payable and paid salaries of employees. Then we have exchange of claims. Examples are receive utilities bill but did not pay. So these are the typical accounts title used. Statement of financial position. As you can see here, the asset, liabilities, both current and non-current. Then we also have income statement, the income and expenses. Now let us learn the accounting cycle. The accounting cycle refers to the series of sequential steps or procedures performed to accomplish the accounting process. These steps in the cycle and their aims follow. However, in this video, we would only focus from step 1 to 4. So these are the accounting cycle, step 1 to 10. Identification of events to be recorded. Then transactions are recorded in the journal. Journal entries are posted to the ledger. Preparation of a trial balance. Preparation of the worksheet. Preparation of the financial statement. Adjusting journal entries are journalized and posted. Closing journal entries are journalized and posted. Preparation of a post-closing trial balance. And lastly, reversing journal entries are journalized and posted. We have here the transaction analysis. Identify the transaction from the source document. Second, indicate the accounts, either assets, liabilities, equity, income, or expenses affected by the transaction. We also have ascertain whether each account is increased or decreased by the transaction. Then, lastly, using rules of debit and credit, determine whether to debit or credit the account to record its increase or decrease. So these are the 4 basic steps.
Next, the journal. The journal is a chronological record of the entity's transactions, which means that all of the transactions of the entity are recorded in the journal. The standard contents of the general journal are as follows. First, the date. The year and month are not written for every entry unless the year or month changes or a new page is needed. In preparing journal entry, date is very important because it shows when the transaction occurred. Next, account title and explanation. The account to be debited is entered at the extreme left of the first line, while the account to be credited is entered slightly indented on the next line. A brief description of the transaction is usually made on the line below the credit. Generally, skip a line after each entry. Then, the posting reference. This will be used when the entries are posted. That is until the amounts are transferred to the related ledger accounts. Basically, it is the account code of the particular account title, and for every account title, there is a corresponding account code. Lastly, the debit column and the credit column. The debit column is where the debit amount for each account is entered, while on the credit amount is entered on the credit column. There are two kinds of entry: the simple entry and the compound entry. In a simple entry, only two accounts are affected. One is debited and another account is credited, while the compound entry requires three or more accounts. The second step of accounting cycle is recording of transaction, or simply transactions are journalized. It aims to record the economic impact of transactions on the firm in the journal, which is a form that facilitates transfer to the accounts. What we do is that we will record all the financial transactions of the entity in the journal. The following are the transactions of Agassi Dance Studio during the month of September. First transaction is initial investment or source of asset. Mark Tuan decided to establish his own dance studio with an initial investment of 400,000 pesos on September 1. In this transaction, both assets and owner's equity have increased. Since he invested 400,000 pesos in his business accumulates cash and capital, which is an addition to assets and owner's equity. To record the transaction, we have to debit to cash and credit to Tuan Capital, both amounting 400,000 pesos. The cash in the debit side represents the addition of asset, and the credit of Tuan Capital represents the increase in owner's equity. The next transaction is rent paid in advance. It is kind of exchange of assets. On September 1, the owner rented studio space and paid 2 months' rent in advance, amounting 20,000 pesos. In this transaction, assets have both increased and decreased. It increases through the advance payment of rental, which is called prepaid rent, which means that there is an additional asset. It decreases because of the payment of 20,000 pesos in cash, which is a deduction of cash, thus deduction from the asset. To record the transaction, debit to prepaid rent and credit to cash amounting 20,000 pesos. The next transaction is on September 4, where the owner hired an artist director and an assistant director, each with a 12,500 monthly salary. No entry is necessary in this transaction, and the staff started work immediately. The next transaction is service vehicle acquired for cash. On September 8, the owner acquired service vehicle for 360,000 pesos. In this transaction, assets have both increased and decreased. It increases for the acquisition of the service vehicle, which means that there is an additional asset. It decreases because of the payment of 360,000 in cash. To record the transaction, we have to debit the service vehicle amounting 360,000 pesos and credit the cash amounting 360,000 pesos. The next transaction is the insurance premiums paid. On September 8, the owner paid JYP Nation Guarantee and Assurance Incorporation 22,800 pesos for a 1-year comprehensive insurance coverage on the service vehicle. In this transaction, assets have both increased and decreased. It increases for the acquisition of the insurance, which means that there is an additional asset, and it decreases because of the payment of 22,800 in cash, which is a deduction from asset. To record the transaction, debit to prepaid insurance and credit to cash, both amounting 22,800 pesos.
The next one is studio equipment acquired on account. On September 12, the owner acquired a studio equipment amounting 80,000 pesos and paying 30,000 pesos in cash and the balance next month. Note that compound entry is needed in this scenario. In this transaction, assets have both increased and decreased. It increases through the acquisition of equipment, which means there is an additional asset. It decreases because of the partial payment of 30,000 pesos cash, which is a deduction from asset. It is noted that the balance amounting 50,000 pesos is to be paid next month. This only means that on this date, September 12, the owner has a liability of 50,000 pesos. Hence, to record the transaction, debit studio equipment amounting 80,000 pesos and credit cash amounting 30,000 pesos and accounts payable of 50,000 pesos. The cash in a credit side represents the deduction of asset and the accounts payable represents the increase in liability. The next transaction is where accounts payable is partially settled. On September 16, the owner paid Park and Choy Merchandising 15,000 pesos of the amount owed. In this transaction, both assets and liabilities have decreased. The payment reduces cash, which is an asset, and it also decreases liabilities. A decrease in assets is recorded by a credit, and a decrease in liability is recorded by a debit. In other words, the accounts are recorded on their opposite sides. Hence, to record the transaction, debit accounts payable of 15,000 pesos and credit cash 15,000 pesos. Next, revenues earned and cash collected. On September 20, the owner conducted a dance training to 10 individuals and collected fees of 10,000 pesos per enrollee. This transaction involves revenue which is a part of owner's equity. In this case, both assets and owner's equity have increased. The collection of a total of 100,000 pesos revenue from 10,000 pesos times 10 individuals is an increase in asset and owner's equity. Thus, as a rule, we should record it with their normal balances, debit assets and credit owner's equity. The journal entry would be debit cash 100,000 pesos and credit training revenues 100,000 pesos. Next transaction would be payment of salaries. On September 26, the owner paid salaries of employees amounting 25,000 pesos. The entity pays salaries on the last Saturday of the month. In this scenario, both assets and owner's equity have decreased. The salaries paid is an expense account, which is one of the factors that would cause owner's equity to decrease. Therefore, the entry to record the transaction is debit salaries expense 25,000 pesos and credit cash 25,000 pesos. And the last transaction would be expenses incurred and paid. On September 30, the owner settled the electricity bill of 12,000 pesos for the month. This transaction is almost the same with the previous one, wherein both assets and owner's equity have decreased. The entry to record this transaction is debit utilities expense 12,000 pesos and credit cash 12,000 pesos.
Next, we will tackle about the ledger. It is a grouping of an entity's accounts. It also serves as a reference book used to classify and summarize transactions, and the preparation of data for basic financial statements. This is part of the step 3 of the accounting cycle. After journalizing the transactions, such accounts are posted to the ledger, which is classified into two. First is the balance sheet or permanent accounts. These accounts are not closed at the end of the accounting period. The permanent account balances are carried over from period to period, such as assets, liabilities, and owner's equity. Second, income statement or temporary accounts. Accounts that are closed at the end of each period, such as income and expenses. Each account has its own record in the ledger, and compared to a journal, a ledger organizes information by account. Next is the chart of accounts. It is a listing of all account titles and their corresponding numbers in the ledger. The chart of accounts is arranged in the financial statement order. That is, under balance sheet, assets first, followed by liabilities and owner's equity. After which is the income statement. First is the income and then expenses. The accounts are pre-numbered to permit indexing and cross-referencing. Presented under each element are the account titles with the corresponding account number. Such will be posted in the ledger after journalizing the transactions. For example, posting to the ledger the cash and its corresponding account number of 110. Now let's proceed to posting. Posting means that transferring the amounts from the journal to the appropriate accounts in the ledger. Debits in the journal are posted as debits in the ledger, and credits in the journal are posted as credits in the ledger. The steps presented will be further discussed with an illustration. For this illustration, under the journal, to record the initial investment, we journalize it by debiting cash of 400,000 and crediting to one capital for 400,000. For the ledger, in this illustration, the upper left part is the account name and the upper right is the corresponding account number. Below is the date, explanation, journal reference, debit, credit, and the balance. After journalizing the transactions, next is posting it to the ledger by following the steps presented earlier. First is to transfer the date of the transaction from the journal to the ledger. The transaction date is September 1, which will be transferred to the ledger. Second is to transfer the page number from the journal to the journal reference column of the ledger. In this illustration, J-1 is the journal reference. Third is to post the debit figure from the journal as a debit figure in the ledger and the credit figure from the journal as a credit figure in the ledger. For cash, a debit of 400,000 and for to-on capital, credit of 400,000. And lastly is to enter the account number in the posting reference column of the journal once the figure has been posted to the ledger. For cash with account number of 110 and to-on capital of 310. Ledger accounts after posting. At the end of an accounting period, the debit or credit balance of each account must be determined to enable us to come up with a trial balance. Each account balance is determined by footing or adding all the debits and credits. If the sum of an account's debit is greater than the sum of its credits, that account has a debit balance. For example, for the cash account, it has a total debits of 500,000, which is greater than the credit balance of 484,800. Therefore, cash has a debit balance. This is the normal balance of an asset. On the other hand, if the sum of its credits are greater, that account has a credit balance. For example, the accounts payable with a total credits of 50,000, which is greater than the debit balance of 15,000. Therefore, accounts payable has a credit balance, which is the normal balance of a liability. Next is the trial balance. The trial balance is a list of all accounts with their respective debit and credit balances. The procedures in the preparation of a trial balance follow. First, list the account titles in numerical order. Second, obtain the account balance of each account from the ledger and enter the debit balances in the debit column and the credit balances in the credit columns. Third, add the debit and credit columns, and lastly, compare the totals. This is an example of a trial balance of Aga Sedan Studio. For the first procedure, listing of account titles for assets, cash, prepaid rent, prepaid insurance, service vehicle, and studio equipment. For liability, accounts payable, for owner's equity, to-on capital, for income, training revenue, and for expenses, salaries, and utilities. As you can see, these accounts are presented numerically or in a financial statement order. Second, enter the debit and credit balances in the debit and credit columns. The first column of amounts is the debits and the second is credits. Third, add the debit and credit columns. For the debit column, a total of 535,000 as well as the total of credits. Lastly, compare the totals. The totals are equal. Therefore, the trial balance is in balance. The equality provides an interim proof of the accuracy of records, but it does not signify the absence of the errors. For example, if the bookkeeper failed to record payment of the rent, the trial balance columns are equal, but in reality, the accounts are incorrect, since rent expense is understated and cash is overstated.
Thank you for watching our video. If you have any questions, you can comment it below. And don't forget to answer the post test. God bless and keep safe.